The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box. I'm Karen Cho with Steve Sedgwick and Arabile Gamede. These are your headlines. Crude prices continue to track higher as Israel launches more strikes on Beirut, ramping up fears of an all-out regional war as it also weighs a response to Iran's missile attack. OpenAI raises $6.6 billion in a fresh fundraising round, giving the ChatGPT maker a valuation of $157 billion. Our US colleagues will be speaking to the OpenAI CFO, Sarah Fryer, today at 15:15 BST.
Elsewhere, more evidence the jobs market not as bad as some people hoped or feared. The US private sector payroll growth topping expectations, whilst traders just reduced their rate cut expectations ahead of Friday's all-important jobs data. Elsewhere, Japan's yen extends its slide against the dollar after its largest single-day decline in more than 2 years. The new Prime Minister says the country is not ready for more rate hikes. Interesting, seeing as the BOJ is supposed to be independent. Anyway, delivering a boost to Japanese equities.
Tesla shares falling as the EV maker misses delivery expectations. That's despite posting its first quarter of annual growth this year.
Maybe we'll touch base on the myth of central bank independence once or twice during this show. Good morning, Karen. How are you? We've got a huge story in technology. I know that you're brimming with excitement about that one. So am I in many ways, actually, but perhaps coming from a mildly different point of view, which makes the show. But first of all, we need to touch base on the biggest geopolitical story on the planet. And with that in mind, let's have a look at the oil price, which I would say is performing pretty well. Yes, we've seen a near $5 rally in Brent, and same for WTI actually, since concerns over an exacerbation of violence and tensions in the Middle East grew. And yet, we're not seeing some of the exaggerated volatility and some of the exaggerated moves that some people would associate with this kind of activity and concern about potential elongation of war between Israelis and Iranians. Now, let's just go through the latest news. Israeli airstrikes killed at least 6 people in Beirut in the early hours of Thursday morning after missiles targeted sites in the city centre. It came as Israel suffered its deadliest day on the Lebanese front in a year, with 8 soldiers killed. On a programming note, we're going to dig deep into the ramifications geopolitically and indeed for global oil markets with Amrita Sen. She is the founder, of course, of Energy Aspects. And stay tuned for that conversation. We'll do that later this hour. Now, back to the technology story.
Indeed, OpenAI raised $6.6 billion in a fresh funding round, which could value the AI company at $157 billion. The investment, which was backed by the likes of Microsoft, Nvidia and SoftBank, cements the ChatGPT maker's position as one of the most valuable private businesses in the world. Kate Rooney filed this report.
OpenAI has officially closed one of the largest private funding rounds in Silicon Valley history. The total coming in at $6.6 billion. This was at a $157 billion post-money valuation. I'm told by a source it was led by Thrive. SoftBank also invested in this round. Microsoft doubled down. You had Nvidia, UAE-backed fund MGX, Khosla Ventures, Altimeter Capital, and I just confirmed that Cathie Wood's ARK Invest was also in this round. OpenAI says the cash is going to help them with AI research and then to increase compute capacity and build tools that help people solve hard problems. OpenAI is, of course, the maker of ChatGPT. We learned today it has 250 million weekly users. That's more than double what it had about a year ago, and then up by 50 million or so in just the past 2 months. It's now one of the most valuable private American companies just behind SpaceX, and it is ahead of Stripe at this point. To put the value in context, at least on paper, this company is now more valuable than Goldman Sachs. If you look at market cap, Uber, Lockheed Martin, and it's about double the value of Chipotle. OpenAI is still, I'm told, in the process of becoming a for-profit company. Kate Rooney for CNBC Business News in San Francisco.
During the latest funding round, OpenAI reportedly asked investors not to back other AI startups, including Anthropic and Elon Musk's xAI. This was first reported by the Wall Street Journal and the Financial Times. The move is likely to stoke existing flames with rivals and comes after criticism from Elon Musk, who sued OpenAI earlier this year over perceived manipulation. Our US colleagues will be speaking to the OpenAI CFO, Sarah Fryer, later today. You can catch that interview at 15:15 BST. So the background here, we have a company that is now worth more than 150 billion US dollars that nobody had even really heard of about 2 years ago. So the ascent of this company has been striking. But it feels like it's holding all the chips that it said to a lot of investors. Now, you can have an allocation, but here's a pair of handcuffs as well. So you're going to lock yourself, tie yourself to us, and you're not going to be investing in other rivals. And let's face it, there are other rivals in the space. And this was something that the Microsoft boss said recently. Satya Nadella was talking about how this industry is becoming commoditized. And I think that's fascinating because this is one of the biggest backers of OpenAI, saying, look, in future, this may just be a dime in the dozen, that the moat is actually very small. And already there's been some comparisons. The FT has done a terrific piece on this saying, look, the moat is not very big. It's not a Google. It may look like it in terms of the build of revenues, but this is a company that's burning through a lot of cash. We don't know what's going to come through in terms of disruption from rivals, given how much money has crowded into this space. So in future, what are you investing in? And I think we all know what commoditized means. We've seen it in many sectors.
I think you've made a superb summary, and I'll just chip at the edges of that as well. You're quite right. They say, look, we're holding all the chips. Well, they're not, as you quite eloquently said. They're not holding all the chips, but they're trying to say to people they're holding all the chips. And this exclusivity, it's not unheard of in Silicon Valley, in Palo Alto, but it is extraordinary. Again, I will go back to the excellent study of the power law, which one of our guests made, and it's a fantastic tome, which I read from cover to cover. And the fact of the matter is, most bets don't work. Maybe two work, and they go exponential, and that's amazing. And I have no doubt that ChatGPT and OpenAI will be stunningly successful. But the fact of the matter is, no one in Silicon Valley ever backs one technology. That's not how if they do, then they're very, very lucky. Then they really are very good at roulette. But most people in Silicon Valley bet on a suite of companies. SoftBank bets on a suite of companies. Nvidia, one of the investors, again, another one, they back on a suite of companies. Nobody backs one as well. So the arrogance of this company saying, if they have said that, you bet on us and no one else, is quite extraordinary. You're absolutely right about those Nadella comments. I thought that was fascinating as well. You're absolutely right about the moat as well. So I can't add to that. But what I will add is about the valuation. It is now 5 times what it was in spring last year. Now, I know a year and a half is a long time in people's psyche and consciousness, but that is quite extraordinary. So let's just dig a little bit more detail into some of the valuation metrics as well. They are hoping to have revenue. Last year, the revenues were $3.7 billion. Now, at $157 billion market cap, that puts this company on an EV multiple off the Richter scale. Absolutely off the Richter scale, with some of the 40 times plus as well, which is way bigger than Nvidia and others as well. But if they do match their sales expectations going forward, which they're expecting the full year 2025 to be somewhere over $11 billion, then that multiple comes down aggressively. So it's not quite as eye-watering. But what it does do, and I just wanted to add this to the broader market as well, if this is going to become one of the other poster childs for the software side of AI rather than the hardware side, which we know Nvidia is the poster child, then this is going to add stunning volatility to the market every time they report on their numbers. To add to that as well, they have got a cash burn as well, and they are not making money. The cost of the AI engineers is stunning. They are the ones who are cleaning up at the moment. A bit like when we had the shale boom, it was the truck drivers and the oil service workers who were making all the money as well. So there are a lot of very big ifs here as well. But the concept of these amazing men and women in Palo Alto, at Sequoia and other places as well, only betting on one company, that's just inconceivable. Yeah,
to the revenue picture, the ability to disrupt SaaS is the big question, whether it can get to that equation, and that's simply not happening just yet. So that would bring another revenue model in, and as you say, could disrupt the market. So that is one potential picture. But in terms of the moat here and what is so special about OpenAI, don't forget Apple didn't line up as an investor here. Apple already has a lot of its chips in one basket around using some of the technology of OpenAI to power Siri when Siri can't get there in terms of the answers. But no doubt Apple doesn't want to be in that position for the long term where it's relying on someone else's technology. This is never how Apple plays its technology game. So no doubt it's trying to come up with its own answers as some other solution, perhaps, to OpenAI.
Yeah, absolutely. I know you're going to look at the broader market now as well, but as you do that as well, it was very interesting to look at that piece by Richard Waters in the FT, which was fascinating. I know we both had a look at lots of copy on this as well, talking about Meta. And Meta said last week that 500 million people are now looking at its Meta.ai at least once a month. And that just shows how captive some of the markets are available to the rivals of OpenAI. Again, Richard Waters' piece in the FT. Fantastic piece. In the meantime, back in the real world, Karen, the US markets.
Yeah, let's take a look at how things played out stateside yesterday. You could see major markets still in the green, but very, very slim ranges there. So it was a fourth positive session out of 5 for the likes of the Dow, second positive session out of 3 for the S&P 500. So you're getting a sense of some of the green. But if you look at the weekly numbers now, as we line up and look towards Friday, you can see the Dow is trading down by almost 1/3% for the trading week, 0.5% coming off the S&P 500. And if we take stock of the Nasdaq, down slightly more than that, reversing by about 1%. So whether we get a session later this week, thanks to the non-farm payrolls that put some green back on the boards, that is something we're of course watching out for. But the big data point, I think a lot of investors now on the sidelines waiting for, because it has a narrative around another 50 basis point rate cut from the Fed, or whether it's going to be 25 basis points as the next move. On that note, let's take a look at treasuries and see how we perched. And you can see the 2-year, we are 3.65%, so slightly high morning session, 3.79 on the 10-year. Green arrows to the upside in all of these yields stateside. To the dollar. Look at the trade this morning. Euro dollar sliding, so we're down 0.1%. We've gone slightly risk off, as you can see. Cable as well, losing territory. 410s down and just hugging the 132 line. Dollar yen, that's where we've seen a lot of movement. It was comments from the new Prime Minister Ishiba saying Japan is not an environment for an additional rate increase. So effectively try to trim some of those hawkish remarks that have been made in recent quarters, which has given the market some fright, or shock as it was called, an Ishiba shock. And dollar yen rates moving the needle on this 0.1% higher morning session. But don't forget, we're 141.65 Monday session, so we're straight a fair distance off that level. Dollar Swissy is firmer morning session. Asian markets, don't forget we're still ex-China. We've got Golden Week playing out, but the markets that are trading, it's a day to the upside for Japanese stocks. Just a stop-start, day up, day down. Today it is 2% higher. Hong Kong markets giving back some territory, 2.3 almost in the red. Australia flat, and you've seen the Nifty 50 down 1%. So you've got a little bit of everything on that board, Steve.
Thanks, Karen. So let's recap on the jobs data so far this week. Of course, we've got weekly claims, and then we've got payroll still to come this week. So far, we've had JOLTS, which was very solid at the top line, although hires and quits were moving in the opposite direction. But anyway, now we've had the private companies under the ADP report adding 143,000 jobs in September, according to the payroll provider ADP. Higher than in August. More jobs being created, yeah? Got that? Okay, higher than in August and ahead of consensus. Now, traders pared back their bets on the Fed easing after the data, now seeing a more than 60% chance of a 25 basis point cut, as opposed to anything more dramatic next month. The former National Economic Council Director Gary Cohen told CNBC that tensions in the Middle East and industrial action at US ports pose a risk to the inflation outlook.
We got the 50 basis points, which we always thought was 25 at Jackson Hole and 25 at the meeting. That was the 50. Then we thought there'd be 25 more in the next 2 meetings. Look, I think there still is probably 25 more in the next 2 meetings, but it's not as positive. I'm not as positive today as I was last time I sat there because of the port strike and because of what's going on in the Middle East. These things can amplify very, very quickly.
Let's bring in David Sequeira, who's Chief US Market Strategist at Morningstar. David, markets yesterday, very muted action. It feels as though caution has now returned. There's geopolitics. We're still waiting up for the data. How are you feeling about some of the market confidence at this stage?
Well, I think the market's really just taking a pause right now. I think everyone's just trying to evaluate whether or not we're going to see more escalation in the Middle East. As you mentioned before, we also have the East Coast, port strikes going on. And of course, more than anything else, we also have the earnings really going to start, here on the 15th. I think we've got the big banks, starting at the end of this week and then rolling into next week. So right now, in our view, the market is just priced to perfection. Stocks are trading at about a 3% premium, overall. And now 3% may not necessarily sound like much, but only 15% of the time since 2010 has the market traded at this much of a premium or more as compared to our valuations? But really, I think what's most important for investors right now is to really note that over the past couple of months, what we've seen is the rotation into small cap stocks and into value stocks. That began in July, and we think that actually still has further room to run.
David, I want to get into that because I can see your positioning: overweight small cap, market weight on mid cap, and underweight on large cap. You mentioned earnings season. What we've heard so far in the narrative is that the bar is very low, so easy to climb over that bar. What sectors does it benefit? Does it still benefit some of these areas like small caps?
We think so. When it's really all comes down to valuations, in our view. So when we look at the small cap universe and those stocks that we cover, small caps are trading at about a 15% discount from fair value. That's still a very deep discount. And especially when you look at how small caps have traded, relative to the overall market, over time. In fact, right now, small caps are trading pretty much at some of the cheapest levels that we've seen going back through, 2010. So again, overweighting small caps is the way to go today. And in order to pay for that, I would underweight large cap stocks, especially large cap growth stocks. But large cap stocks trading at about a 4% premium overall.
David, I note you're underweight on technology. You were just talking about with Karen there as well. With that in mind, I just want to tap your brain about something that is not in your notes, and that's this OpenAI valuation as well. Is it symptomatic of a problem in technology valuations, or is it just something that's an outlier? Because for me, it's extraordinary leap of faith on that kind of valuation.
It's probably more of an outlier at this point. And when I look at the technology sector, overall, it's trading at a 6% premium to our fair values. But it's also going to be, very idiosyncratic on individual names. So, for example, Apple is a 2-star rated stock, trades at over a 20% premium to our fair value. I don't think our team is necessarily all that impressed with our AI rollout. We are seeing some sluggish sales in China and probably slower purchasing, with the iPhone 16 coming out as well. Oracle is another one. That's actually one of the more overvalued stocks in our mind. It's a 1-star rated stock, trades at a 50% premium. I think the market's just overestimating the long-term growth in their cloud business. And I know our concern there too is that they're probably going to be losing market share with their, legacy database types to newer database types coming out there. But, not everything is negative in technology. We still get behind Microsoft. That's a 4-star rated stock, trades at about a 12% discount. Again, they're still just hitting on all cylinders. And according to our analytical team, we think that its Azure cloud business is actually accelerating into the second half on AI this year.
David, I've got to get into a couple of these stock picks. I mean, Kraft Heinz, you think it's trading at a 40% discount? I'll mention Kellogg as well, trading at a 35% discount. Given your initial comment to Karen about the market being priced to perfection, what's the market getting so wrong about these companies?
Well, I think it's just the value category in and of itself has really just gotten left behind for the past year and a half with the frenzy of everybody hyper-focused on AI stocks over the past, 18 months. So a lot of these stocks have just gotten left, far behind. Now, they also had some problems with their margins over the past couple of years. In an inflationary environment, they weren't able to keep up their own pricing as compared to how fast their costs were going up. With inflation moderating, we are expecting, margins in these type of companies, to start improving over the next couple of quarters. Kraft Heinz specifically, we also recently upgraded that company's economic moat rating to a narrow moat. The reason behind that is they did switch their strategy. They're really much more focused on driving long-term profitable growth, as compared to a couple of years ago when they were just chasing short-term earnings at the expense of brand value.
What about consolidation, though, David, when it comes to some of these players from Kraft Heinz to Kellogg? Because we've seen in the sector what Mars, Kellanova, PepsiCo now talking to a tortilla maker in the US. Consolidation has been a huge theme. Could Kraft Heinz go in that direction?
Yeah, we could see that. Actually, the one that I would point out there is going to be more in the small cap space, and that's WK Kellogg. Another 5-star rated stock, trades at a 35% discount, has a pretty healthy dividend yield at 3.6%. And of course, WK Kellogg is the split up from Kellogg a couple of years ago when Kellogg split into the traditional cereal business away from the snacks business, which is the Kellanova business. And here, we're looking for some supply chain and manufacturing modernization to drive margin expansion. So that actually could be one that is probably undervalued enough that it could get a look from a couple of different people.
David, we've got to leave it there. I've got 10 seconds left. How's the weather in Chicago, especially in the mornings at the moment? I'm just asking for a friend.
Oh, well, it's about midnight here right now, but the weather actually has been very nice. We've had some very good fall weather this year.
Yeah, that's my worry. Just asking for a friend for next Sunday. Okay, David, thank you very much indeed for that. David Sekera, Chief US Market Strategist at Morningstar.
It's always one of those things when you've had a lovely week before you travel somewhere, it's perfect weather.
Yeah.
You know that something's about to turn just as you touch down.
Perfect weather is a different thing when you're doing different things in Chicago.
Yes.
Arabile, you wouldn't know about that.
Let's not run away with things, but here's something that is coming up then. It's on the rundown. Japan's new Prime Minister. Oh, what's exactly been said there? Well, he says the country is not in a position to hike rates again. We'll bring you more after the break on that one. OPEC sticking to a planned production increase in December. We'll take a closer look at the implications of the oil market later this hour. And we'll bring you our interview with the State Secretary in Germany's Federal Ministry for Economic Cooperation as he discusses global trade and cooperation. That's coming up then at 6:45 PST.
Karen and I have read a lot of words on a repetitious basis over the years, but the following words, pretty frequent.
Right.
The Bank of International Settlements is warning. It's like they're always warning about something. It's like, I think
true. If they said they were happy or relaxed,
I mean, they got it right in
something,
2007. You know, so let's give them a bit of credit. Anyway, the Bank of International Settlements is warning. What is it this time? Okay, there you go. He's got it on the screen. That the next inflation crisis could force central banks to hike rates faster and more aggressively as conflicts, climate change, and trade wars rattle the global economy. The BIS's deputy head, Andrea Meckler, has said central banks will no longer be able to simply look through price instabilities as supply disruptions become more frequent and ingrained. Yeah, especially in the ports in America. Let us move on. The Bank of England is warning. Oh, God, they're all at it today. The Bank of England is warning that global asset prices are vulnerable to a sharp downward correction as geopolitical concerns mount. Well, there you go. The BOE also highlighted rising risks around US government debt. Hedge fund short positions in treasuries totaled $1 trillion as part of so-called basis trades, or the difference between prices and future contracts, with the bank warning that an unwinding of these positions could lead to severe stresses. In the meantime, Japan's new Prime Minister Shigeru Ishiba says the country is not in a position for further interest rate hikes. Interesting. He's not the BOJ governor, is he? Anyway, okay. Country's not in a position for further interest rate hikes. These comments follow Tuesday's meeting with the governor of the Bank of Japan and mark a shift away from Ishiba's reputation as a policy hawk. Lynn joins us from Singapore. Lynn, I had to check out the BOJ website just to confirm what the Bank of Japan Act says. Stipulates that with regard to the bank's monetary policy independence, the bank's autonomy regarding currency and monetary control shall be respected. And yet you go down a little bit into the weeds, but it is a common practice that we work with the government in order to ensure stability as well. So independent or not, I'm still questioning.
I think you raise a very important point there, Steve, because of course we do have the Bank of Japan Act, also the governor of the Bank of Japan appointed for a fairly long fixed term there of 5 years. But we also know that there are ways in which the government can influence the Bank of Japan. For example, there is an article in the Act which says that a finance ministry official can sit in on the board meetings, and while that person does not have a vote, that person can put forward a motion, for example, to request the Bank of Japan to not raise rates. That's an example. And we also know that the Prime Minister can exert some of that pressure, or whether that's privately or through jawboning publicly as well. But it's interesting because Capital Economics, they had a note out recently talking about this very point, because we had obviously had the other candidate there in Sane Takeichi also being an ultra dove and a supporter of Abenomics, being the investor favourite there. And they examined this issue, saying that ultimately it would not be a very good look for the government to be exerting, especially sort of public pressure on what is supposed to be an independent institution, particularly as the Bank of Japan has been pulling away in terms of tapering the JGB purchases, and in terms of what message that would be sending to those bond investors in particular, given Japan has obviously massive public debt. But away from that, in terms of what we've seen in the market, the response, of course, is that off the back of Ishiba-san's comments, which was seen as a U-turn, because in the past he has been seen, one, as fiscally conservative, and two, as a frequent critic of Abenomics as well as ultra-loose monetary policy. However, changing his tune in terms of talking about putting through a fiscal stimulus package for low-income households, and then, of course, these comments about the rates environment. But, of course, a lot of this has to do with the domestic politics, the fact that he has called this snap election, which is just over 3 weeks from now, and he's got a huge task ahead of him. When you look at the Nikkei polling, for example, his cabinet only scoring a 51% approval rating. That is the lowest on record that we've seen from the Nikkei. So he wants to build that mandate with the public. He also needs to, of course, reunite the party. And of course, that is a bit of a tailwind when we see the FX picture for Japanese stocks today.
Fabulous coverage. What a shock, isn't it? Man who has election coming up says doesn't want higher cost of money for the Japanese population. Quite extraordinary stuff. Never seen that before. Thank you, Lynn. That was perfect.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.